Hello and welcome to Asking for a Trend. I'm Allie Canal, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. First, a rocky start to the month of December for stocks. The major averages closing at the lows of the day as the selling in Bitcoin and crypto spread into the broader market. We've got the takeaways of the trading day and what you need to think about before the open on Tuesday. Plus, the rise of prediction markets has sports betting and trading platforms making major changes. But the surge in popularity could come with risks for consumers and credit. We take a closer look. And the holiday shopping season is in full swing. We've got insight into how sales are shaping up so far as Cyber Monday comes to a close. While prediction markets are seeing a massive surge to end the year, with platforms like Polymarket and Kalshi suddenly drawing big money and big players. But as more people pile in, so do the questions about financial risk. Joining me now is Mahir Bhatia, BofA Securities Payments Analyst. And Mahir, prediction markets used to be pretty niche. Now we have these big exchanges, we have big investors. Is this the start of a new asset class, or is it just, another form of gambling at the end of the day?
Good afternoon, Allie, and thank you for having me. So I think that's an interesting question. I think in a lot of cases, it is, while prediction markets and sports betting, I think it's hard to argue that is an asset class, right? At the end of the day, what consumers are doing is making a call, whether it's from a predictive standpoint or it's just sports wagering, making a call on where they think how a particular event is going to unfold. So I would classify it a little bit more in the camp of gambling and wagering. And from our perspective as a consumer finance analyst, one of the things we worry about is just credit risk and consumers getting overextended and how companies can deal with that situation. So from our standpoint, I think it's just a way for consumers to potentially overextend themselves and lose money.
Yeah, let's talk about some of those credit risks, what that poses for companies, for lenders, along with consumers. What are you most focused on here with the rise of predictive markets?
Yeah, so I think it's important to say a couple of things here, right? First is it's early days in these markets. So, research is still developing, but what we have seen from academic research and from other data points is that consumers do tend to see an impact on their credit scores, on instances of bankruptcies, credit delinquencies, when sports betting in particular becomes more widely available, particularly online or through mobile apps and mobile phones, as opposed to just being generally available. And so that's something that we're quite focused on. But again, I do want to keep it in context, right? The headline numbers tend to highlight how much was bet, but consumers don't obviously lose everything that was bet. Only a small percentage of that is actually the losses. But that said, for a lender, this is a new risk, right? If you think about underwriting models, they were built on historic data, typically, and that was in a world where consumers couldn't just pull out their mobile phone and make a bet or a wager and potentially lose some money that way. So from our standpoint, the risk really is that there could be some mispricing of risk. Lenders have built their underwriting models and have sent out credit cards or personal loans, assuming a certain type of risk appetite, and now you're having a new risk vector potentially introduced for the consumer.
So if that risk keeps growing, is this an area where regulation or guardrails can contain it? And is Congress or other government entities, are they even prepared to handle something like this at this point?
Yeah, no, absolutely. You could see some, Congress and you could get some guardrails from regulators. We don't have a particular, I personally don't have a view on where that is and whether Congress has the appetite or the desire to implement something like that at this time. I think what's more important, for an issuer or a credit card lender or a personal loan lender is they're going to have to take the action themselves, right? They cannot wait for regulation and they cannot wait for someone else to do the job for them. They have to manage their credit books, so they have to monitor their portfolios quite closely and see how this develops in different jurisdictions as that risk becomes more prevalent. I think that's what you'll see lenders do, is that they'll have to manage their books a little bit more proactively and account for this new risk vector.
Now, it's interesting, Mahir, because your research shows that the biggest impact is concentrated among younger men, lower income consumers where liquidity is already tight. So why is that the case, and why are they most vulnerable here?
Yeah, I think it's, some of it is just from the fact of that these people generally have less income, particularly when you think of lower income folks, or subprime populations. They tend to be a little bit less historic, like they're subprime for a reason. They tend to be a little less responsible in managing their credit. And what you tend to see is that with some of these gaming apps, the interfaces, the way they're set up, their prediction markets are really set up around this idea of gamifying the entire experience, incentivizing folks to bet more. And those are the populations that tend to be more active in these apps. And therefore, I think that's where the risks are. And then you combine that fact with the fact that, someone who's lower income or someone who's historically been less responsible in managing their finances, hence they ended up in the subprime tier, is going to be a little bit more at risk because they just have less buffers in place, right? They just have less income, less savings to fall back on than maybe someone else. So it's a combination of both where the companies are targeting and just personal behavior.
So how do you think this feeds into the K-shaped economy narrative that we've been discussing for quite some time? Does this worsen that divide maybe?
Potentially, yes, right? Potentially, yes. But again, I do want to keep it in context that, it's still early days. It is, and you do want to think about the fact that not all the headline numbers of, the dollars wagered is not necessarily everything that's lost. But that said, yeah, I think it worsens it, right? I mean, if the people who are going to be losing money are more susceptible to some of the advertising, some of the incentives that are put in place tend to be some of the people at the lower end of that K, if you will. And if those folks are losing money, it does worsen the dynamics around the K-shaped economy.
Yeah, super interesting stuff. We'll see how the prediction markets play out. But Mahir, thank you so much. Appreciate it.
Thank you, Allie.
Well, stick around. Much more asking for a trend still to come. Stocks slide as Bitcoin tumbles to start the last trading month of the year. Here with the trading day takeaways is Yahoo Finance's Jared Blikre. So not a great start to December, I would say.
No, so we were dealing with 5 straight up days to end the month of November, pulled out a win in the S&P 500 and I think the Dow to make it 7 up months in a row. And then we just kind of fell apart overnight. Yeah. What happened? There was something interesting going on with the Bank of Japan. We can get into that in a minute, but I just want to show you what happened today. Here's the Dow closed at the lows of the day, so down 0.9%. It was leading the majors, and it's always interesting to me when the Dow leads as opposed to something else. I'm not going to make too much of it because there's a lot of different things going on, and it could be some weird beginning of month stuff. And again, this is the holidays, and you don't really have as much volume and volatility as normal. Russell 2000 was actually a bigger underperformer than the Dow, down 1.25%. But you know what was positive here was the Dow Jones Transports, and it was only positive by 2 basis points, so it actually continues its winning streak. It is up 6 days in a row. All these are kind of arbitrary measures here. One of the things I was looking at with the 10-year, that was a big factor, I think, in some of today's sell-off, just because it's not the absolute level of bonds sometimes that really scares stocks. It's those big moves.
And the rate of change.
Exactly, the rate of change. And so 8 basis points to the upside, that was the biggest, I think, in 3 or 4 months, maybe a little bit longer. Here's the 30-year. It was also up 8 basis points. And we have a VIX of the bond market, the ISB of a move index. Let's see if we can get a year to date. It's only printed at the end of the day. Not really seeing any change here, so maybe that's not indicative of anything. But I was tracking the VIX as well. That was up just slightly. But you can see, here's the entire year in the VIX. We just had 2 minor scares. And today's action, you can't even see it. That's how small it was. So really not a problem here. Hopefully we figure out, get some kind of balance towards the end of the month. And by the way, one more thing. Ryan Dietrich points out that when the market is up big heading into December, the first 2 weeks can be choppy. So there you go.
All right. So potentially some choppiness to kick us off. Now, you mentioned the Bank of Japan.
Yes.
Does that have anything to do with the yen carry trade? Yen carried away. It popped up, I guess, a little bit.
Yeah, this is something that we get to talk about maybe once or twice every year. And this was a total non-event. So overnight, there was some chatter that the Bank of Japan might be raising rates. later in the month. And so that sent their yields soaring. And then in sympathy, and I think it is sympathy here, that our own bond rates here, because they have to remain competitive, well, they rose as well. So that's where you get that 10-year up 8 basis points. And by the way, this is a year-to-date chart of the 10-year, and you're going to notice that we are actually coming off of the lows of the year. So yields, when we talk about levels that are a problem, it's usually the upper yields, or the higher yields, excuse me. So stocks don't like really high levels in yields, and especially when they're moving fast to the upside or the downside. The carry part. So when you have an economy like the Japanese yen, where you can borrow at really low rates, you can then take that and you can invest it overseas in a commodity company or country or an asset market which has higher rates. It might be the US dollar, it might be Brazil, it might be the Australian dollar. Anyway, when that unwinds, you have to pay those dollars back. And so that affects the foreign exchange market. It also affects the bond market. Here's what happened overnight. This is intraday. You can see the US dollar, this is versus yen, was sliding. So the yen was getting stronger as this line goes down, but then it bounced back. I'm going to show you, I'm not sure if this is going to show up here, but here's a 2-year chart of the yen. And back in August of 2024,
I remember that well.
This is what happened then. And you can see that was a huge, huge slide here. What we're talking about was right here. So in proportion, this was almost nothing. This is just a blip. And what I'm saying, we get to talk about it, but it's not a big deal right now.
We'd rather it be a non-event than what we saw in August 2024, because we all remember the panic that happened there. But of course, we can't
Even that only lasted a few days.
Exactly. So context and perspective is everything.
Excellent.
But something that hasn't lasted a few days is the slide that we've seen in Bitcoin. And unfortunately, the hits just keep on coming.
Yeah, it was funny because that slide, that backslide started in October before we saw weakness in equities there. And of course, stocks have recovered here in the US since then. But let's go to my crypto board and we can see the overnight action. And especially since Friday, a lot of the Bitcoin ETFs are showing even bigger losses because they're measured since Friday's close. So here you have Bitcoin down 5% over the last 24 hours, Ether down 7%, Solana down 8%. And a quick look at the technicals here. Let's get a 3-month chart. This is going to show us the all-time high, 126,000 and change. And there you have, okay, early October, that was the peak. And then we started really sliding in November. And what's funny is the correlation between US stocks and Bitcoin kind of stuck together. But when US stocks would go down by a little, Bitcoin would go down by a lot. So sometimes correlation can be misleading too. So US stocks, especially tech, remains highly correlated to Bitcoin, but Bitcoin is a magnified move of what has been happening to US tech. And the flip side of that is when tech has been recovering, well, Bitcoin hasn't been moving up that much. So here's what happened over the last 3 days. You can see big down move there. That was arguably that was induced by the yen-induced sell-off as well, except this one stuck. And that kind of underlies my thesis is that these losses in Bitcoin, you got to be careful because they're not getting recovered. We saw stocks climb back today, at least some of them did, but not so much in Bitcoin. And I would further add, here's my key level. Let me dial up the year-to-date chart. 75,000, that low right there, which is also the high from a previous year. There we go. That is my key level in the sand. Until we reach then, I think we're just kind of chopping around. I think we do touch it.
Yeah, Bernstein said that resistance level could be between 70,000 to 100,000. We'll have to wait and see where things go. But Bitcoin prices, they're down around 9% since the start of the year. But Jared, thank you so much.
Thank you.
As always, appreciate it. Well, stick around. Much more asking for a trend is still to come. It's Cyber Monday, and spending is expected to top $14 billion. Yahoo Finance's Julie Hyman had the chance to speak with Coresight Research during Market Catalyst for more on this holiday spending season.
So from our store visits, we had a whole team out in stores on Black Friday. We think that young fashion retailers, beauty specialty retailers, they were very strong. We saw very strong performance in terms of store traffic at Macy's too. And we've got Macy's earnings coming up later this week. We think that Black Friday overall is going to be giving a renewed impetus to holiday. We think that there was a bit of a lull in shopping in October. Coresight tracked sentiment heading downward in October. We tracked a bit of a lull, a bit of a kind of pullback in holiday shopping. We think with the government shutdown over, with sentiment stabilizing, that Black Friday will give a kind of impetus, a renewed push to the remainder of the holiday season. So we think it was a strong Black Friday. Yes, store traffic was down a little bit, but online sales were up strongly. A lot of retailers saw very strong foot traffic on the day. So we think overall it looked like a pretty good Black Friday, and we think it'll set the scene for a stronger rest of the holiday season.
I do want to broaden it out, but I just want to focus on Macy's for just a second, because that has been, as our Burke De Palma has noted, such a kind of surprise performer this year. So what do you think is, in particular, when you guys were looking at the foot traffic there and the traffic overall, what's getting people into Macy's and getting them excited? Is it deals? Is it merchandise? What's going on?
So Macy's is always a Black Friday winner. When our teams go out in stores every Black Friday, we see very strong traffic at Macy's. However, you're right, it is on the front foot. Last quarter, it reported positive comp growth, which is very encouraging. So we are going to be looking when Macy's reports later this week to see if it can maintain that momentum. We know that Kohl's, its biggest rival in department stores, it reported a much improved performance in its most recent quarter. So Macy's will be hoping to track that kind of sequential improvement. We'll also be looking from Macy's, particularly on commentary on the middle market shopper versus the high income shopper. So Macy's Inc. is relatively unique in that it spans high-end Bloomingdale's to more middle ground with the Macy's nameplate. So we're going to be looking for management commentary. We expect that the high-income consumer has been driving and will be driving holiday spending. We're going to see what Macy's says about that. But it had a good last quarter. It's investing in stores. It's getting shopkeeping basics right. And we think that's an encouraging kind of springboard from which to grow comps going forward.
John, I want to ask about inventory management also, which sounds like a pretty dry subject, but has become more interesting this year because of what's been going on with tariffs. So were the retailers able to manage their inventory adequately, competently enough that they had in stores enough of what people wanted?
So on Black Friday, we saw very well stocked inventory. We thought shelves were very stocked, kept very well replenished. Thinking about the department store specifically, they pulled back very slightly on inventory in the second quarter. Year over year, they pulled back very, very lightly on inventory. Other retailers, of course, have been pulling inventory in early in the year to get ahead of tariffs or potential tariffs. What we have observed at the store level is that inventory was pretty solid on Black Friday. There weren't major gaps. There was solid availability. And we think that sets retailers up, including department stores, up for a solid rest of the holiday season.
John, all of us have had the experience of wandering into a store and through a store unable to find anyone to help. Have retailers sort of gotten better, or what's this sort of staffing cadence look like right now?
So that's really interesting. I mean, it is still a relatively tight labor market. At CoreSite, we track holiday hiring, and actually holiday hiring is at the lowest level this year since we started tracking it. It is very low. A number of retailers haven't disclosed how many people they're going to hire for the holidays, which is unusual. You know, big names that would usually disclose their hiring have not disclosed that, which we take as a pretty firm signal that they pulled back. So holiday hiring is much weaker. We think retailers have been playing cautious on that. But yeah, you're right. Service is absolutely something that stores have to fight back with. And it's something Macy's has been doing. Macy's has been investing in service, in staffing, in the store environment. And for a company like Macy's, which has to justify effectively its difference versus more value channels, that's exactly the right area to be investing in. You know, digital channels are growing fast. We're seeing agentic AI support digital sales growth. So how do stores adapt around that and cater to that? They have to invest in service, and that is typically delivered by people in store.
And John, just to zero in on Cyber Monday, since here we are, you talked a little bit about it there, kind of that omni-channel interplay, but specifically online, what are the experiences that are winning this day, that are really appealing to where customers are right now?
So online experience as well. I think what we've seen is that promotions have been stretched out over a much longer period. But also what we're seeing is agentic shopping. So consumers are going via ChatGPT to do comparison shopping and ultimately checkout, whether that's checkout on ChatGPT or checkout on the retailer's website. So they have these incredible tools now available, these consumers, that can do the comparisons for them. They don't have to trawl necessarily around a whole bunch of websites. They can get that information, pull it in, and do that comparison. So shoppers are much more equipped digitally. And in terms of experience, yeah, the experience traditionally online has been pretty kind of functional. We have seen this Black Friday a greater emphasis on in-store experience. Companies have been offering giveaways, product launches. They've been trying to add in some of that kind of excitement of Black Friday morning. So we're seeing a lot around experience online and in-store.
Well, that's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet.